Consistently profitable. Let's break that down. Profitable, meaning you have a strategy or a system or a way of trading that creates a profit. Consistently, meaning that you trade that strategy or system in a consistent way. You're not constantly switching strategies and systems. You're not missing trades. You're trading it consistently. That is what creates a consistently profitable trader. Let's switch gears. Right now, don't do this. Disclaimer, do not do this right now. But right now, if you were to go buy the dollar Swiss, you would have a 50% chance of this market going up or going down. That is logic. That is statistics. Statistically, this market has a 50% chance to either rise or fall. But most new traders are not trading based on statistics and logic. I know I didn't at the beginning of my trading career, and you may not be doing that right now. What do most beginning traders actually trade based on? Emotion, not logic. Most beginners are trading based on emotion. Again, I dealt with this same problem, and this is what emotion causes. Although we have a 50% chance of the dollar Swiss going up or down right now, let's say you go out and buy the dollar Swiss. Well, trading based on emotion means that what you're going to end up doing, and I see this all the time, is you're going to buy this and you're going to watch it drop a little bit, but you're going to be so hopeful that it comes back at least to break even because this is your hard-earned money that you're going to let this loser keep going until it becomes absolutely unbearable, and this may be where you take your loss. Now, the same emotion that took you this far on a loss is going to cause you to cut your winners early. You're going to start winning a trade. Let's say you go out, same exact trade. You place a buy trade and it pushes up. And it pushes up a little more, but you get so excited that you exit your win right here. Now, let's do some simple math. If this was our buy, this was our target, this was our loss, and we had a 50% chance to win, if your winners look like this and your losers look like this and you have a 50% chance to win, are you going to make money? Absolutely not. You are going to lose money hand over fist, and this is what happens to so many newer traders. In today's video, this is what I want to teach you how to avoid. I want to teach you how to trade based on statistic and logic, trade like a robot would instead of trading with emotion. Stuff like this can annihilate your account. So in today's video, I want to make sure that you do not do this any longer if you're already doing it. And if you're not sure how to trade with a consistent and profitable system, I'm going to teach you that in today's video as well. So if you think that is something you will enjoy, go ahead and click that subscribe button down below the video to the right hand side. We do videos like this each and every week. Click the like button to help out with the YouTube algorithm, and follow us over on Instagram for more content at the Trading Channel. I will see you after the intro and disclaimer to teach you how to become a consistently profitable trader. See you there. Let's start the same way we did at the beginning of this video. Consistently profitable. Let's break down profitable. What do we need to make profit? Well, the most simple way to make profit is to have a strategy or a system that wins over 50% of the time with a 1-to-1 risk reward. The other way would be to have a strategy that wins 50% of the time or even a little bit less and have a greater than 1-to-1 risk reward. For instance, winning 2 for every 1 that you lose. But in this video, since it is dedicated more towards beginners, that's what we're going to focus on today, is the over 50% chance to win with a 1-to-1 risk reward. Now, how can we make this happen? Well, as technical analysts, we have a few different ways that we can create an edge, that we can create an advantage in order to win more than 50% of our trades. Some examples of that would be structure, candlestick patterns, moving averages, indicators, just to name a few. The list goes on and on. And the way we create a strategy, because using one of these on its own, let's say you were just to trade every time the market hit structure support, you would lose money. What if you were just to trade every single candlestick pattern? That would not create a profit. But there's a correct combination of these things that will create a profit. And I'm going to show you a strategy combining these in just a second that you can use to actually get an edge over the market, and that I have tested and has shown to give an edge over the past 5 years on the Aussie dollar. We're going to take a look at that in just a second. But with all these things combined, what actually creates a strategy is simple. It is conditions, entries, stops, and targets. An example of this, really quickly, would be, an example of a condition would be, I need the market to be oversold. Here's our RSI, and let's pretend this went oversold just for this example. RSI is oversold. I need a long wicked candle after the RSI is oversold. I need this to be at a previous level of structure. All of those would be conditions. My entry is a close above the long wicked candle. That would be your entry. My stop loss goes below the wick of the long wick candle. That would be a stop. Target set at a 1-to-1, target set at previous structure resistance. Any way you want to take targets is totally fine, but you need to have a statistic advantage with that way of taking targets. And that's what we're going to discuss right now. But now, since you know what a strategy is, you know it's conditions, entries, stops, and targets, what I'm going to do is head over to some charts and break down a strategy on the Aussie dollar that proved over the past 5 years to create a profit if traded consistently. Let's take a look at that strategy right now so you'll have a complete understanding of the profitable side of being a consistently profitable trader. Let's look at that right now. Okay, so here we are on the Aussie dollar chart, and every red line you see is a loss, every green line you see is a win with the strategy I'm about to show you. And if you want to pause the video and count all these lines, you're welcome to, but I'll save you the trouble. Over the past 5 years, it produced 23 losing trades and 42 winning trades. That gives 65 total trades. 42 over that 65 means we have a winning percent of around 65%. So is that greater than a 50-50 chance? Yes. So what we've done is combined conditions, entries, stops, and targets, which I'm going to share with you in just a second. And what we've done with that strategy that we've used, that we've created now, is I have created a over 50-50 chance of winning whenever I'm placing a trade. And that's how you become a consistently profitable trader. Not just that, you also have to be consistent with this strategy, with a strategy that creates an edge, that creates profits. And we're going to talk about how to be consistent right after this. I want to go over the profit side first, show you how to be profitable, and then I want to show you how to be consistent to that profitable trading strategy. So let's go ahead and take a look at this strategy. Exit out of this. I'm going to take a look at 4 examples. I'm not going to put you through going through every one of these. I might do 5 examples of this strategy, but it's an extremely simple strategy, and it goes like this. For this strategy, you are going to need the 12-period exponential moving average. I have mine right here. Here's the EMA. The setting is 12. The source is closed. If you're using TradingView, copy this. 12-period EMA, and you will need an ATR indicator. ATR, for those of you who don't know right now, is just an indicator that gives you the average of the last 14 candles. I use this so that I'm not just placing standard stop losses like 10 pips or 20 pips, because some markets move much more volatile than others. Some pairs may have a candle that moves 100 pips in one candle, while other pairs have candles that only move 20 pips. So I want to make sure I'm congruent with the amount a certain currency pair is moving. The way I do that is with this ATR indicator. I suggest that you go take a look at a video I'm going to post in the top right hand corner of the screen. Did a full video on the ATR if you don't know what this is. So this is the ATR indicator. I have it set to a length of 14, meaning it measures the last 14 candles and gives me the average of them. That's the only 2 things you need on the chart. And these are going to be a part of our stops, targets, and conditions. So let's go ahead and talk conditions. Conditions always come first in a trading strategy. For this trading strategy, my condition is I want to see a cross of the 12 EMA. My purple line here is the 12 EMA that I just showed you. A cross of this, for me, is determined by the close of a candle. So I want to see a candle close above the 12 EMA. After that close above, I look at the next 5 candles. After these next 5 candles, I cannot trade any longer. But if within these next 5 candles, I see a candlestick pattern that looks anything like this. Long wick to the bottom side. This is for a buy trade. We're going to look at some short examples too, so don't get confused. This is just for the long examples, the buy trades. I'm looking for a candlestick that looks like this within 5 candles of the cross of this 12 EMA. So let's delete this and take a look at what we have here. We have our cross of the 12 EMA with this green candle, right? It closes above. We then look 1, 2, 3. Does this candle look like I just showed you? Long wick to the bottom, small top wick, small body. Yes, it does. So therefore, this would be an entry. Unfortunately, this trade lost. It's very important that I show you this. I need you to understand that having a profitable strategy does not mean it's a strategy that wins all the time. Having a profitable strategy means over a large sample size of trades, 60 to 100 trades, you are going to have an edge or an advantage above 50-50 and above a 1-to-1 risk reward in order to get a profitable strategy. So let's keep looking. Here we have another example where we pushed down, we pushed below here. What do we do here? We crossed back above with our close of this green candle. Once we cross back above, what do I do? 1, 2, 3, 4, 5. Move this out of the way. Does this candle have a long lower shadow, small body, and small top wick right here? Yes, it does. Therefore, that would be an entry. And I ended up losing that trade as well. But here we go. Let's look again. Now we have a cross below right here because the candle does close below our 12 EMA. We have 1, 2, 3, 4. My fifth candle is the last one that I can actually look at for a possible trade. So what if this candle would have been exactly what I was looking for? Could I have taken that trade? No, because this would have been candle number 6. I only look 5 candles after the close above or below the 12 EMA. So with that fifth candle, I'll move my green to get it out of the way. You can see it was exactly what I'm looking for. Long top shadow, small bottom shadow, small body in general. That would have been a trade. After I teach you guys the strategy itself, we're going to go over stops and targets in just a second. So bear with me here on this. Now we have a market pushing down. It pushes back up. Do we close above the 12 EMA here? Now I'm looking at 1, 2, 3, 4, 5. I don't have to actually look that far because this first candle has a long lower shadow, small body, no upper shadow. Therefore, I'm entering on this candle. That's 4. We'll do one more example. Let's push the market forward, push forward, push forward. And so you can see what it looks like to not have a trade. We have a break and close below here. If we look 1, 2, 3, 4, 5 trades after that, 5 candles after that, excuse me, we have no entry. Here would have been an entry, but it's 6, 7 candles afterwards, and I don't trade the 7th candle. I only trade 5 after the break and close of the 12 EMA. So this was our break and close below the 12 EMA. The next 5 candles is all I'm looking at. We have another break and close above here, looking at the next 5 candles. No hammer looking candles. So therefore I continue moving. We have now a break below 1, the second candle after that break and close below. Break and close below here, 1, 2. Is that the kind of candle I'm looking for? Does this candle have a long upper shadow, small body, small lower shadow? Yes, it does. Therefore, that would be an entry. So that is an example of our conditions and entries. Hopefully at this point you understand the strategy portion of this. Now we're going to talk about stops and targets, which are also part of the strategy, but let's go ahead and go over that now. What you see in the top right-hand corner of your screen right here, I'm circling it, is the value, the ATR value of the candle that you hover over. For instance, if I hover over my entry candle right here, and you look in that exact corner, it says 85.8, which really means 85. The last number does not count on the ATR indicator. So 85, that means that this is an 85 pip ATR candle, this candle is. With that being the case, all I'm doing for stops and targets on this particular strategy is adding 10 pips to the ATR. So what would that look like? For a stop loss, I would have my entry on the close of that candle or the open of the very next candle. Wow, this thing got wide, didn't it? Goodness. Okay. All right, there we go. We're back at it. So I would have 85 or 86 plus 10, which would be 96, right? So I have a 96 pip stop loss. The stop did not get hit. And for this particular strategy, again, this was just a quickly made strategy. You can go test this for higher risk reward ratios, a lot of different things. Let's keep this simple though. Again, this video is geared towards beginners. So with a 1-to-1 risk reward, did I win this trade? Yes, quite easily, right? We had our stop loss at 96 pips because it's 10 pips plus the ATR value of the candle, the entry candle. We have a target set at a 1-to-1 risk reward. Therefore, this was a winning trade. If we take a look at this next trade, another winning trade. If we have our push up here, 1, 2, 3, this was the 4th candle right here, and it is in fact a hammer looking candle, small body, almost non-existent body, long lower shadow. Therefore, I would have a long entry here just to give you one example of a long entry, and then we'll move forward. These things come out so big. All right, so we have a long example. The ATR of that candle, look up in the top left corner of your screen, is 72 pips. So 72 plus 10 would be 82. 82 pips would be my stop loss after the entry. 82 pips would be my target, and a 1-to-1 risk reward was hit. That is exactly what each and every trade you see on the screen is based on, and that is what provided a little bit above a 64% chance to win a trade at a 1-to-1 risk reward. What is that called? We just went through the entire strategy itself. That is the profitable side of consistently profitable trading. And what I want to teach you right now is the consistent, sustainable side of consistently profitable trading. Profitable trading, 65% chance to win is incredible. Having a 65% chance to win is more than casinos have, and they make millions and millions of dollars a year. Casinos only have about a 5% advantage. And with a 65% chance to win, you have a 15% advantage over the market. So you're tripling what casinos do with a strategy like this. So that's the strategy portion, the profitable portion of the video. Now let's take a look at the consistency portion of the video. What do you need to be consistent to a strategy like this? Let's talk about that right now. Okay, so we've talked about strategy. We've talked about the profitable side of consistently profitable trading, but how do you know that a specific strategy gives you an edge like this? I just showed you the entire strategy, and what you see on the screen, these lines, is a process called backtesting. I realize I haven't gone over that yet, and I want to because, again, this is geared towards beginners, and I want to make sure you understand how to see if a strategy actually is profitable. This is the manual labor part of trading. I can't backtest for you. After you create your own strategy, you feel like it gives you an edge. What you do is go back through historical data to the point that you have at least 100 trades tested, and you test every single trade that happened that met your strategy, that met your conditions, your entry reason, your stops, and your targets. So that's why I was looking at the chart, and every single time the market closed above the 12 EMA, I looked for the next 5 candles and looked for a hammer looking candle. Every time we crossed below the 50 EMA, I looked at the next 5 candles and looked for a shooting star look-alike candle. So with that being the case, you would do that until you have 100 trades tested, and that's going to give you a big enough sample size to know if this has the probability of giving you profits leading into the future. Nothing's set in stone, but it gives you the probability that it's going to have profits leading into the future. So that's the process of backtesting. Now, let's talk about consistency. Let's switch gears. So now that you know everything you need to know about the profitable side of consistently profitable trading, you know how to build a trading system, and what I just showed you, the backtesting process, will show you whether or not that system or strategy, those conditions in entry reasons and stops and targets, are probable to give you an advantage in the future of over a 50-50 chance to win and a 1-to-1 risk reward at least. So that's what we just talked about, right? Now, let's dive into the consistency portion of consistently profitable trading. How do you work on consistency? And what I need you to understand is consistency comes down to being comfortable. If you are comfortable, you will be consistent. If you are uncomfortable, you will not be consistent with your trades. And what do you need to be comfortable with? Well, you need to be comfortable with the losses that your system or strategy will come with. I cannot stress this enough. Every strategy, every system will have losses. And you need to be comfortable with the amount of money, actual money, that you lose during that series of losses. And I have worked with tens of thousands of traders around the world, and I've only seen 2 things that, once perfected, can make someone go from an inconsistent trader to a consistently profitable trader. Once these 2 things are perfected, then you're comfortable and you have no other choice but to be consistent because you're comfortable with your system, your strategy, and with the amount of money you're gaining and losing. What are these 2 things? Well, first off is backtesting. What we just talked about a second ago is backtesting. And let me bring up a spreadsheet to help me go over this point. What you see in front of you is the 2020 spreadsheet so far in the EAP Training Program. This is a spreadsheet based on every email analysis I have sent out so far in 2020. These are alerts I send out 3 to 5 times a week for members of the EAP Training Program. If you want to learn more about that program, the link is in the description. Just to go over the spreadsheet really quickly, it gives you the average wins, the average loss in terms of how much money you made or lost on a trade, which right now we have a 1.55 average risk reward. It gives you the amount of pips you've made. It gives you the total trades, which is 40, and this is through the end of April, so we're averaging about 10 trades a month. The total wins was 26. Total losses so far was 14 with a 65% chance to win. This is what consistency can do for your trading. 65% chance of win and we're risking around 2% per trade, 1% per position, trading 2 different positions, giving us a total gain. With money management, we increase our position size every time we win a trade, decrease it every time we lose a trade, and it's all done for us in the spreadsheet, but gives us a total gain of 65% so far, and this spreadsheet is only calculated through the end of April. So that's a total of 4 months, 65% gain. Pretty incredible, right? But let's get back to the backtesting portion. What backtesting does is allows you to see the probability that your strategy or system has. So let's say you test a strategy or system and you see that throughout 100 trades, when you're backtesting, you want to test at least 100 trades. You see that there's a point throughout those 100 trades where this strategy or system has 7 losing trades in a row, but by the end of the 100 trades, it's still extremely profitable. Now, are you comfortable with that scenario? Would you be comfortable losing 7 trades in a row on live markets since you've seen it in the past, you've watched it happen, and you've watched your system come out of that drawdown? The answer is yes. Now tell me, if you had done no backtesting at all, like most traders, unfortunately, this is what they do. They don't do any backtesting. They just go out and start trading random things. When you do the backtesting, it prepares you for situations like this. Let me show you this on our spreadsheet. So far this year, we had a moment right here where out of 7 trades, we lost 6 trades and only won 1 trade out of those 7. Now, without backtesting, this system, the way I have, the system that I trade in the EAP, without backtesting it through thousands of trades throughout different currency pairs and time frames, there would be no way I would be consistent because I would not have the discipline, because I'd never seen this strategy go through this type of drawdown. And if you've never seen it before in the past, then you just assume, shit, winning 1 out of 7 is not what I want to do, so I'm definitely going to just quit the strategy right here after 6 out of 7 trades lose. I'm done with this strategy. What would have happened if that was the case? Let's say you did no backtesting and you lose 6 out of 7 trades. You would have missed out on this huge winning streak we had over the entire next month. So this is what you miss out on if you haven't done the backtesting properly and you're not disciplined. That's the first thing that whenever traders master the process of backtesting, actually doing it correctly and spending the time doing it, although it is a hassle, this is the discipline it can create for your trading. You can go through drawdown with a whole new mindset of, I know that I'm going to come out of this drawdown on top if I consistently trade a plan or a strategy that is proven to give me an edge over the market. Number 2 is risk management. So many traders are out there risking way too much money. If I went through this same drawdown, which ended up being, if you go all the way over right here, you'll see that this was a minus 8.24% drawdown right here. So if I went through the same drawdown and I was risking, let's say 5% per trade instead of 2% per trade, this would have been closer to a 22% drawdown. I'm not comfortable with that. I would not be able to stay disciplined. And if I'm not comfortable, what does that mean? I can't be consistent. So in order to work on consistency, you have to master 2 things. You have to backtest properly and backtest enough trades to see your strategy or system go through drawdowns. So you can tell that it hopefully is going to come out profitable by the end of a large sample size. 2, you have to master risk management and make sure you are only risking an amount that you are comfortable losing. You are only risking an amount that if you go through a drawdown, the amount of money you lose doesn't make you so uncomfortable that you quit trading or blow your trading account or switch strategies or whatever it may be. And once you have those 2 things mastered, you will have the consistency part down. You will be comfortable with your trades. That will create consistency. You already have what we talked about in the beginning, a way to find profitable edges over the market, profitable strategies. So now you have everything you need to be a consistently profitable trader. As I said earlier, this spreadsheet is through April of the EAP Training Program. The email analysis I send out is 3 to 5 email alerts I send to every trader that's involved in the program, showing them examples of the strategies that I actually teach in the program. Each and every one of these trades is based on a strategy they learned in the EAP Training Program. The EAP Training Program comes with a full training course. I'll put some testimonials from some of the recent graduates on the screen so you can see what they have to say about the program. And if you would like all of that plus priority email, meaning any trading related questions or questions about the course that you have, I will personally be getting back to you through email as quickly as possible. You will have a dedicated email address where you can contact me with any questions you have. That is priority email, also included in the EAP training program. So if that sounds interesting to you, go ahead and click the first link in the description labeled EAP Training Program, and it would be a pleasure to have you aboard and to work with you on speeding up your process to hopefully becoming a consistently profitable trader. And if that's not something you're interested in, that's totally fine. Just be sure that you have it locked here and you're subscribed to the trading channel, because we come out with free educational content just like this each and every week, and it would be a shame if you missed any of it, because shit's getting pretty good. Also, make sure you follow us over on Instagram. We do pre-release videos over there, and hit that like button for me to help out with the YouTube algorithm. Leave me a comment if you have any suggestions on future ideas, and I'll try to throw it in the next video, and I will talk to you very soon. Lily, jump up. And just as a bonus here at the end, this is Lily, beautiful golden retriever. You go, girl. See y'all later.